Welcome back to another Explainer. Let's jump right in because today we are putting on our investment analyst hats to dissect a truly transformational moment for a major player in the industrials and building products sector. We're talking about Gibraltar Industries and their massive, game-changing $1.335 billion acquisition of OmniMax Air National. If you've ever looked at fundamental investment analysis and wondered how a mid-cap company completely rewires its DNA to accelerate growth and build long-term intrinsic value, well, you are in exactly the right place. We're going to unpack the financials, the strategy, and the real-world execution of this mega deal. Okay, let's quickly run through our agenda. We'll start with Section 1, the billion-dollar catalyst. Then Section 2, reshaping the business model. Section 3 covers financial health and ratings. Moving into Section 4, unpacking first quarter results. Section 5 looks at synergies and debt reduction. And we'll wrap up with Section 6, the 2026 growth outlook. Section 1, the billion-dollar catalyst. To really put this into perspective, we are looking at a $1.335 billion all-cash transaction. I mean, that is just massive scale. For a company that had a market cap hovering right around $1.2 billion before the deal's full impact was priced in over time. Now, according to Fitch Ratings, this transaction values OmniMax at a 12.1 times multiple, based on projected 2025 EBITDA of $110 million. And here's the kicker. That multiple is before management even factors in any of their estimated synergies or tax benefits. So in value investing terms, because that multiple excludes synergies, management is effectively building in a margin of safety for the investment right from the start. It is a really bold, decisive deployment of capital. You can clearly hear the strategic intent in the words of Gibraltar's chairman and CEO, Bill Bosway. When the deal officially closed in February 2026, he stated, quote, "The combination of our complementary brands opens new opportunities in our existing swim lanes, leapfrogging our building products growth strategy ahead by years." End quote. Leapfrogging. That's the operative word for us here. They aren't just buying revenue. They're literally buying time and rapidly accelerating their intrinsic value. Moving right along to Section 2, reshaping the business model. Before this deal, Gibraltar was diversified across residential, ag-tech, and infrastructure. But post-acquisition, the pro forma revenue mix shifts dramatically. The residential segment is now going to represent over 80% of total revenue and adjusted EBITDA. And why does this matter so much for our investment thesis? Well, because the vast majority of this residential exposure is tied to the replacement market. We're talking about essential things like roof repairs and rainwear upgrades. This replacement-driven demand is incredibly resilient. It's way less cyclical and largely non-discretionary, which provides a much more stable earnings floor and, frankly, a solid defensive economic moat compared to just relying on volatile new home construction. Now, to achieve that 80% mix, Gibraltar essentially absorbed an absolute powerhouse. OmniMax is an industry leader in residential roofing accessories and rainwater management solutions. They bring a whole stable of established brands under the Gibraltar umbrella, names like Amerimax, Berger, Flamco, and Verta. But crucially, OmniMax also brings these long-standing, deeply embedded relationships with major building product distributors and the biggest home improvement retailers out there. Expanding that distribution footprint is what's ultimately going to drive the top-line growth capabilities of the newly combined company across the U.S. and Canada. Let's transition to Section 3, financial health and ratings. If we look at the baseline metrics, Gibraltar's trailing 12-month revenue was sitting at $1.14 billion. But looking at the Fitch Ratings profile post-acquisition, we see a company that's expected to leap to roughly $1.7 billion in pro forma revenues for 2026. Because of this newly expanded scale, their strong profitability, and a very manageable debt plan, Fitch actually assigned Gibraltar a first-time BB long-term issuer default rating with a stable outlook. To fund the whole shebang, Gibraltar took out $1.3 billion in new senior secured term loans and upsized their revolving credit facility to $500 million. PitchGrade's SWOT analysis gives us a really great neutral perspective on this new financial profile. On the strength side, Gibraltar is maintaining solid profitability with a baseline 27.1% gross margin and historically strong free cash flow. However, looking at the weakness column, even with OmniMax on board, their scale is still a bit small compared to massive investment-grade peers like Masco or Owens Corning. They do have a huge opportunity to capture share in an $8.4 trillion global industrial market, but they're facing immediate threats from macroeconomic sensitivity, especially housing downturns, and significant raw material inflation, particularly with aluminum. Which brings us to Section 4, unpacking first quarter results. There is a stark contrast here between the headline numbers and the operational reality. If you just casually glanced at GAAP earnings per share, you'd see a 40-cent loss. But Digging deeper, that loss was heavily driven by $32.6 million in one-time pre-tax expenses directly related to getting the OmniMax deal done, things like closing fees, integration costs, and fair market amortization step-ups. When you strip all that noise away, the adjusted EPS shows a 45-cent profit. This really proves that beneath the messy accounting of a massive merger, the underlying operational engine is still humming and generating healthy, consistent earnings. And man, the top-line growth is just undeniable. Q1 net sales jumped from $246.4 million in 2025 up to $356.3 million in 2026. Now, the absolutely crucial point to remember here is that this massive 44.6% increase includes only 2 months of OmniMax contributions since the deal didn't close until February 2nd. So even with a somewhat soft end market and some disruptive weather, those scale benefits we talked about are immediately visible. Moving into Section 5, synergies and debt reduction. We always want to see manageable debt levels, and management is taking a highly disciplined approach to paying down those new term loans. They started right out of the gate in February by selling off their renewables segment, the eBOS business, for $70 million, applying that cash straight to debt reduction. By the end of 2026, they plan to realize $16 million in EBITDA synergies. Their stated goal here is to reach a 2.0 to 2.5 times net leverage within 24 months, representing a very conservative debt level for an industrial business. And eventually, looking out to year 3, they aim to unlock a total of $35 million in annual cost synergies. And they are clearly moving fast to make those synergies a reality. In just the first 90 days, Gibraltar deployed 22 integration planning teams and executed over 500 milestones. They've already knocked out phase 1 of their organizational restructuring. But honestly, even more impressively, they're already executing on revenue synergies, successfully cross-selling complementary Gibraltar and OmniMax products in over 60 existing customer locations. The fact that over 50% of their synergy commitments were executed right out of the gates, that is a huge indicator of strong, competent management. Finally, let's look at Section 6, the 2026 growth outlook. Despite that noisy first quarter we talked about, management remains incredibly confident in the combined company's future earning power. They reiterated their full-year 2026 guidance, projecting net sales to hit somewhere between $1.76 and $1.83 billion. Adjusted EBITDA is expected to reach up to $326 million, pushing adjusted EPS into the $3.65 to $4.05 range. Now, that adjusted EPS range is the ultimate bottom-line metric we care about when evaluating the success of this deal, because it represents a massive step up from their historical baseline. But, it's not going to be a complete walk in the park. Management explicitly called out accelerating commodity inflation during Q1. This was driven by spiking aluminum prices and rising fuel costs, heavily linked to ongoing conflicts in the Middle East. But to defend their margins and protect that economic moat, Gibraltar didn't just sit around and wait. They proactively executed price increases across 14 of their residential brands in March and April. They expect this aggressive pricing action to yield positive price-to-material economics as soon as the second quarter, which really proves they have the pricing power to successfully pass costs through and maintain their margins. And that brings us to the ultimate takeaway for you to chew on today. Gibraltar has completely rewired its business model, securing market leadership and dramatically expanding its scale. But as we know in investing, execution is absolutely everything. Can they seamlessly integrate a billion-dollar acquisition, fend off raw material inflation, and rapidly pay down that debt, all while navigating a softer housing market? The Q1 results show they are off to a blistering start, but the real test lies in the quarters ahead. Keep a close eye on those margin trends and cross-selling metrics. Thanks so much for joining me for this explainer, and I'll see you in the next one.